Hey guys, how's it going? Lee here. Now you may have seen recently videos on YouTube talking about an index bubble that the economy is currently in. And now this all started with an interview with Michael Burry, but this talk about an index bubble really ties in well with the looming discussions that we're having about a recession that's coming about. And while I'm not a fan of making these kind of videos, I think it's really important to understand how debt works, the dynamics of the economy, and how we can best prepare for that. So in this video, I wanted to cover about index bubble, what that actually means, what was it like in 2008, 2009, and how does it compare to now, and what you should be looking at. So if you've seen the movie The Big Short, which you should go watch it, it's a great movie, really funny, Michael Burry's in that, and he's the guy who basically predicted the dot-com bust in the early 2000s and then the mortgage crisis that we had in the States in 2008 and 2009. And so basically he's come out and made a prediction that the next financial crisis is going to come about in the stock market, with all the money being flooded into there due to the demand and the popularity that's come about from index fund investing, which is how you get your index bubble. So to give a bit of context, I want to quickly just delve into Michael's claims and talk about what happened in 2008, as he's claiming the subprime CDOs back then is the equivalent to the index funds that people are investing into now. So the playing field back in 2008 and 2009 was filled with high hopes for the American property market, right? So you had many big investors from around the world wanting to invest into the American property market. And so although they wanted to participate in the American property market, they didn't want to deal with being a landlord. They didn't want the overhead. They didn't want to deal with all the paperwork of transferring titles and ownerships and what that involved. What they really wanted was just the interest that was being paid through these mortgages, which were being issued quite extensively. So CDO is an asset-based security. So it gathers bonds, it gathers certain assets, which include mortgages, and basically an investor buys that and it collects the cash flow from that, which is what these investors from all around the world wanted from the US. And because there was such a high demand for it, billions and billions and billions of dollars of these CDOs were being sold to international investors. And with so many of them being sold off, some investors had a higher appetite for risk, and so they would buy riskier ones, which is where we get into our subprime CDOs, because our subprime CDOs were packaged with subprime mortgages. Now these subprime mortgages were being given out with really low FICO scores, and FICO was basically an algorithm or a system that they used to run credit checks to basically see your serviceability to whether you can pay off the mortgage or not. The Australian equivalent of that would be just looking at your proof of income, bank statements, the expenses and your outgoings, and if you're able to service these your loans for your mortgage if the interest rate just went up slightly. This of course all varies for different banks, and it all really depends on the bank that you're going with and the lending conditions at the time. Because if lending conditions are loosened, which is what happened in 2008, then well, these banks will give out loans willy-nilly because people probably aren't checking. But the issue with the subprime mortgages was that there were no checks on any sort of proof of income that was coming through, and loans were just given out to anybody and everybody. Which brings me on to the first issue. The issue of accessibility and passivity. Now, when you give people easy money, even if it's for the purpose of putting a roof over their head, consumer confidence becomes rather high because people can get it easily, they can purchase what they want, it doesn't really matter if it's too expensive because, well, the bank's giving us the loan for it. Which, by the way, high consumer confidence is great for an economy because it boosts asset prices. People are more willing to buy things, which is great. I'm not knocking that off. But at some point, the lending has to cap. Now, if you look at the lending space and the lack of consumer confidence around the world at the moment, many countries, and I hope not, but Australia seems like it's heading towards that way, might be heading into negative interest rates just to encourage people to start investing and putting their money into assets. Now, if you look at the lending space right now, there's very little confidence with many of the marketplaces around the world, and many of the economies are actually going into a negative interest rate just to help boost the economy keep going along. Like, they just keep it kicking the can down the road until something catastrophic happens, because no country wants to willingly admit or show that they're going into a recession. But you could easily argue that some of the European countries have definitely or are currently in a recession. But regardless, it was a mix of high consumer confidence and negligent bank practices that caused the whole GFC to happen in 2008 and 2009. So at the moment, with debts being at an all-time high, banks still wanting us to take out loans, and a GFC, which occurred not too far long ago, people are really starting to lose confidence within the economy, especially in the housing. And so what many people have done is looked at alternative pathways to get the best ROI on their money and build their wealth, which is the stock market. So how does accessibility and passivity affect the stock market? Now, the internet in particular, and this is where I learned first about the stock market, to be honest with you, has been pumping videos, in particular on YouTube, to show people how to invest passively with low fees, high accessibility to passive index investing, and for the low cost of, well, I don't know, what's the lowest index fund you could buy or ETF you could buy. Anyways, under $100, you can be diversified across 200, 500 to over 1,000 different companies domestically and internationally. And I don't know how much more passive you want to be about that, short of your bank or your employer investing for you, once your pay comes in every fortnightly, weekly, or monthly. It's extremely passive. But due to that passive nature, low cost and barrier of entry, and being well diverse across different markets, it's a no-brainer for many people to put their money in the market through these vehicles such as index funds. Now, due to the people flocking towards the stock market, the top 10 companies of any market or any index fund, the share prices for those top 10 companies have been shooting up drastically, because when you invest in an index fund, they buy the same type of companies which they have portioned out accordingly. So the same companies will get the same amount of allocations all the time. Now, with more people flocking towards the stock market, we have more brokers that are emerging in the space, all wanting their share of the pie. And recently, Charles Schwab, TD Ameritrade, all these other brokers going to zero commission trading. And some brokers allowing even more accessibility by allowing you to buy fractional shares. So instead of being able to afford one whole share, you can just reinvest a portion of your money back, and keeping your money within the same platform and within the same market to buy even smaller portions of that share. This, of course, makes sure that the market has every single penny that you have, and that was going to escape in the form of a dividend gets reinvested right back into the market. But when we're talking about more people flocking to the share market, I want to make it very clear that I'm not saying that there's more people in the share market or that there's more shares, like, it's being overcrowded. When you have more people into the share market, one of two things has to happen. Firstly, either the company issues more shares, and generally that comes about from wanting to raise capital. So in that instance, it's actually quite horrible for current investors, because what you're doing is you're diluting the pool of shares for current investors. And so the value of the shares actually goes down, because now you've got more shares, and different people can sell at different prices for different reasons, which might cause a whole sell-off in itself. Or number two, which is more likely the case at the moment, with the current shares, people are just willing to pay whatever price it's currently at. And so more people come in, the prices keep shooting up because there's more demand for those type of companies. And so that's the issue, right? When you invest into these index funds, they have to buy the top 200, the top 500 companies again and again and again and again, no matter what. It's robotic. That's the beauty of it. It's predictable. But in saying that, there has to be a seller on the other side selling those shares. So these share prices will just keep going up and up and up as demand just keeps flowing through. So now, having an understanding of CDOs and how, that all kind of went wrong, and what's happening with index funds at the moment with the accessibility and passivity that they offer, what is the major difference between 2008 and 2019 and the mechanics of the stock market? It's important for us to understand that the major difference between 2008 and 2019 is that back then, people were using leverage and debt. And now, I'm not saying that people aren't using leverage and debt at the moment, to start investing in the stock market, but most people aren't. Most people are investing their own capital into these index funds that they've earned. Whereas in 2008, people were mortgaging way beyond their discretionary means and what they could afford for their own home. And so once jobs were being cut, people couldn't make repayments, the sell-off began. However, in saying that, although people don't have to make repayments, on these index funds that they're already invested current capital into, there's going to be a problem when there's a slight scare within the market. And this is what people are talking about, the whole recession, all that kind of stuff, which, by the way, can happen from a small event like a, manufacturing plant breaking down in Vietnam, which then has a lead-on effect to bigger brands and bigger companies, which then could trigger the actual trade war and all that kind of stuff as well. So there's really no way in telling what's going to cause the recession. But if 2009 can tell us anything, it's that when people don't understand or know what they're doing, there's going to be a massive scare. And when there's a scare, it's a cascading effect. And you can see this in the index funds, right? People passively investing into these index funds, putting their money in there because it'll be diversified, it'll be okay. But when a scare comes about and people start selling off, just like they did in the housing crisis, just like in property and stocks, there has to be a buyer and a seller. So when somebody is willing to sell their stock of a company or an index fund for a certain amount of price, but there's no buyers because buyer confidence is at an all-time low, and a stock price that would normally go for $80, somebody's willing to pick up for $30, guess what's going to happen? Eventually, they're either going to meet halfway, which probably isn't the case if there's that much of a scare, or the sellers will go all the way at the bottom because they're looking to liquidate quite quickly. And so your stock that could be $80 one day slips down to $30, and then that cascading effect happens, and then people start selling it off quicker. And because there's not enough buyers, then there are sellers, then the share prices keep getting lower and lower and lower. And so for somebody who's investing passively, to see their 40%, 50% of their net worth gone within a couple of days, that can be quite scary. And as much as I love liquidity, getting in and out, that's the issue with accessibility, passivity, and having high liquidity in the stock market. It's much easier to sell out and call it quits when you don't understand the dynamics of an index fund, that you're actually investing into businesses, not just stocks, businesses, because these are shares of actual businesses that provide products and services that we use on a daily. Now, if you're from Australia, you don't have to go too far at all just to see an example of this. Last year, we had a Royal Banking Commission. What happened there? Sentiments were at an all-time low. People were selling out of their bank stocks. As a result, the index funds, the ASX 200 were slowly dripping down, and then it just started becoming a massive sell-off of the banks. And so although the markets are meant to be rational, remember that we're all still humans and we have emotions when it comes to investing, and that's why behavioral, finance is such a big topic. And I'm just starting to learn about it and get my head around it as well. But whenever I learn a new concept, it makes so much sense because I've made that mistake, or I've had those thoughts in my head as well. It's not until you understand the mechanics and what these businesses represent that you can actually stand your ground and hold strong. And that's what I fear for a lot of people who have gone into index fund investing and not having that prior knowledge, or not willing to learn and take the onus of learning about what they're investing into their own hands. Man, I hate doing these negative type of videos because it's so actually draining to do. But anyways, if there's any lessons or anything you can do to prepare for this crash or index bubble, which by the way, I wouldn't worry too much about because you never know when it's actually going to hit or happen. Take from Warren Buffett's learnings and buy when others are fearful. Have cash on the side. I definitely have cash on the side, which keeps my nerves in check. And I'm never too worried about the money that I invest in the stock market. And a great opportunity that I see with all the money flooding into the index funds is looking at mid-cap stocks that have been left totally on the side and that nobody's looking at the moment. That's where a lot of my money's been made in the stock market at the moment. I do invest for dividends, but at the moment I see so much growth in these tech stocks that are just people aren't looking at. Well, I mean, a few people are looking at, but the people that are investing in index funds are totally ignoring. So definitely have a look at your mid-cap stocks. But apart from that, that's it for me today, guys. I hope you guys enjoyed it. I hope you guys got a lot out of it. Start some discussions below if you have any questions about the index bubble and all of that and what you could possibly do. Remember, general advice, not personal advice or anything like that. I'm no financial advisor. But apart from that, guys, that's it for me. Catch you guys next time. Cheers.